Yo, it's Hublo back with another video. So today we're going to be doing a video on institutional trading, and this is a big one. A lot of people still don't know about institutional trading, even though you got things like quote unquote ICT, smart money, stuff like that, and we'll dip into a little bit of smart money things in here and whatnot. But institutional trading is a big thing. For anybody who doesn't know what institutional trading is, it's mostly how the banks, trade the big money movers, the market movers trade, and kind of the manipulations and things that they do in the market to affect us retail traders that are not trading with as much capital as they are. So the things we're going to go off of is Wyckoff theory, smart money concepts, liquidity traps, and how to trade like institutions and avoid retail traps. Okay, so retail traders versus institutional strategies. Traders often follow trends. Retail traders typically rely on market trends for decision making. Institutions use complex algorithms. Institutions employ sophisticated algorithms to analyze vast data sets. Retail lacks resources. Retail traders generally have limited access to advanced trading resources. Institutions gain from markets. Institutions can significantly impact market movements through large trade positions. So they're them just having more capital than retail traders, and or more retail traders, more money of the institutional side being more than the actual retail traders that are trading in the market, um, capital altogether, and they can fluctuate and move the market as they please, just with one tick, one position, and yeah, it's crazy. I've seen it, and I hope you've already seen it too and experienced it. But if you haven't, you'll get there. This is just a video to kind of help you be prepared for that. So the Wyckoff theory is definitely something I guys want you to take notes on, but also research your own uh, theories and things like that on the Wyckoff theory as well. I do have a chart on in my Discord regarding the Wyckoff theory and how it kind of plays out. Smart money and liquidity trap. So the Wyckoff market cycle. So Wyckoff theory analyzes market phases and trends. And then the smart money forecast. Smart money uses data and experience to predict shifts. Liquidity traps trap traders. Liquidity traps mislead traders, leading to losses. Traps aid strategy. So recognizing traps enhances traders' strategies and decisions. So knowing when market is heavily fluctuating, or when it's a when it's a get a notification from trading, a trade is doing something, but I'll check it later. Um, so when a liquidity trap is happening, that's when market fluctuates, very, fast, and there's no news or anything that's coming out. That could be a sign of that. Stop loss hunts and things like that. People think that those are like fictional things, and I get it. There's certain things when it comes to the market that are very fictional, that are put out there. But to be honest, with just my experience in the market, I think that's definitely something that does happen, and it's true. Um, the Wyckoff theory, understanding market cycles. So, accumulation phase, institutions slowly buying large stakes. Institutions strategically accumulate shares to avoid market disruption. Price consolidation and smart money. Price stabilizes as informed investors establish significant holdings. So this is the accumulation phase. This is when the market is, getting geared up to go into a buy. And this is definitely something that a lot of retail traders don't really know about. So definitely make yourself more aware, and also do your own due diligence and research on accumulation phases. Markup phase, price surge up, a price breakout signal, the start of an uptrend. Late retail traders. So late traders miss gains, increasing market volatility. And why that happens is because when you already missed a move, and then now you're thinking, okay, it's going to continue up. So all the retail traders that's trading off FOMO, they start getting in, and that's when the market volatility even shoots up even higher because a lot of people are already missed the move, so they're trying to catch up with the institutional money, and they're trying to make those moves and get up to where they're making up for what they've missed below as price uh, surged up really quickly. Distribution phase. This is a phase in which the market starts to start trying to sell. Institutions sell assets to maximize profits. Top buyers, retail traders, often chase markets due to FOMO. So that's exactly what we were just talking about. As the they see the retail traders start to chase that buy for the FOMO, they start to settle into the market and put and start to cause distribution in the market to where all those people that was chasing the market is now their stop losses are getting either hit or their accounts are getting liquidated because they use FOMO in order to trade, a fear of missing out. Markdown phase. So price drops post distribution. So after distribution, price typically declines as supply overwhelms demand. A cycle of institutions. Institutions often re-enter markets, uh, perpetuating established wick off cycles. So usually the market will kind of go up, and because those people have FOMO, it'll necessarily have those people buying there. It'll liquidate their money, and then smart money or institutional trading will get in the position where they originally made the market take off at. So you got to be aware of that, and that's definitely one thing that happens a lot in the market. It happens a lot differently now than when 2019, 2020, and that's just how long I've been trading. I've been able to see the evolution of how the market moves now, in difference to how it did move. Back then, it just kind of like wicked, and then it would just, when it came back to that area where it originally pushed up or it originally went down, it would wick and then just go to its destination after that. But nowadays, it kind of plays, it kind of consolidates. It's trying to make people lose money all in between that before it definitely makes that move up. So you definitely just got to be patient and make sure that you're paying attention to your trading when it's that time. And let me see. I'm just gonna check this trade real quick. I'm not gonna lie, y'all, because I don't even think I even put a stop loss on this. Okay, it's doing great. It's doing fine. It's doing great. Okay, so smart money concepts: how institutions manipulate price. So order blocks. So last candle as zones. So use the last candle that it created before the big move as zones. Institutions mark key zones with last bullish or last bearish candles. Price back to zones. So price often retraces to these zones for reversals. So usually price will kind of come back to these areas, like I said, due to people, trying to chase the buy. Price end up coming down to that area and buying up again. So always trade with a conscious mind. Always make sure you're checking your emotional state and never trade when you have a fear of missing out. Liquidity zones. So retail stop loss. Retail traders place stop losses at key levels. Institutions shift trend. So institutions trigger stops to reverse markets. So when you're the difference in between these two is when you have a retail stop, which we're all retail traders that are possibly watching this video right now. When we have a stop loss, there's an order book in which institutional money sees where everybody's stop losses are. So that's not really anything you can avoid, but that is a key level in which price can sometimes come into because everybody's stop loss is at a key level, and institutional money wants all that. It wants all that money. It wants to take as much people out of that move before it makes that move. So that's one point I'll hit on. So institutional shift trend. So after it triggers the stops, usually it'll reverse the market back in the other direction. for all those individuals who, again, were having FOMO, thinking that, okay, it's reversing that position and it just took me out of buy. I'm going to sell now. Okay, do that if you want. It's going to possibly reverse back, to the original buy in which it was going to do originally. So you got to be careful when trading, and just FOMO is just not a great way to go about that. So make sure that you're always, doing your due diligence, following news. But a lot of these shifts and price movements that we're talking about right now usually happen when big money comes into play, not usually when news comes into play. Break of structure, BOS, and change of character. BOS, market shift. Break of structure signals a major market change. I use break of structure a lot in my trading. Change of character, not so much. I kind of just, it's kind of like the same thing to me, to be honest, but I wanted to put it in there just for people who like to choose different lingo for almost, the same things, and just helping everybody understand it entirely. So, character change signals possible market reversal. So, when, let's just say you have a pair on a higher time frame that's, giving you a lot of buy indications on the lower time frame. You got to break a structure. You got everything, looking nice, but then all of a sudden, we end up getting a break of structure down below after the price just gave us a break of structure up. That is called a change of character. Now price may be definitely going in a whole nother direction, because you got one break of structure and then you got price breaking down below now. That may be an indication to shift direction in your strategy, or shift directions in your bias when it comes to trading this specific pair. Liquidity traps: how institutionals trick retail traders. Stop hunting. So price spikes above key levels. Institutions trigger stop loss orders for sudden moves. So it does it really quick. Sometimes you won't even be expecting it, but it happens. It happens to all of us. It has happened to all of us. And we got to try to find a way to kind of navigate that. One way I would definitely say is just, use proper risk, to where you still get to stay in the game and possibly capitalize for the right direction. When it does start to go that way, if you see price start to go in the direction that you originally intended, but you just got stopped out. Optimal price orders. They execute trades significantly to maximize profit. So that's what institutional money does. They optimize their positions to make sure that they're maximizing their profits to the T, to the maximum, and that's why they stop hunt, because they have to maximize their profits. Everybody who's riding their wave with them is, essentially taking, money out of their pockets. So they use their money to push the market down, take everybody out, so they can uh, make as much money as they can make off that specific move in the direction that they want the market to go. Fake breakouts, price breakouts, levels. Institutions create false signals to mislead retail traders. Sharp move traps traders. Sudden reversals catch traders off guard, causing losses. So that's exactly what we were kind of talking about before. Just false breakouts, false, impulses, things like that. That's why it's important to make sure that you're looking at support and resistance, things like that, and making sure that you're using market structure, looking at news. Make sure you're doing the necessary steps before the market starts in the week and during the week, to make sure you're adhering to not only the pair that you're trading, but your proper risk that you would like to be taking at that time. Liquidity pool. So large orders placements areas. So institutions strategically place large orders to manipulate market movements. So they would put orders in certain places in order to manipulate market movement, kind of like buy orders, sell stops, stuff like that, in order to create these liquidity pools. You have to kind of like be in the game for a little bit for you to like kind of recognize that. And if you guys want examples of that, definitely comment below, and I'll make another video of us showing like a little bit of examples of that. But price reactions strongly at those zones, and price often spikes or drops sharply when reaching these zones. So you got to make sure you be careful, because sometimes they can put that at a certain point of price to where their positions automatically get activated, and now it just drops the market, and it can make the market fluctuate very vigorously when that happens. How to trade like institutions and avoid retail traps. Identify liquidity zones. So stop loss near highs and lows. Institutions often place stop loss orders around key levels. So make sure that you stay aware of that. So make sure you're looking at quarter points, things like that. So always looking at key levels in order for you guys to place your stop loss if need be. But make sure you always follow your trading plan and how much you're willing to risk percentage wise, and or how many pips. Excuse me. Watch for fake breakouts. Be cautious. Institutions may manipulate price movements intentionally. Everything is intentional, guys. Everything's intentional. Nothing's by mistake. Everything's by design. Even the world we live in, and how everything is as far as like the system. You got the people below. You got the people that's above. People that's above been above for long periods of time. Of course, this is a trading video, so I can't really dive too much into that. But what I would say is everything is by design. Nothing is by mistake. Everything's intentional, guys. So make sure you guys are always protecting your capital, always staying in the game, and always staying mentally sharp when you're trading. Trade at order blocks. So institutional buys and sell zones identify key order blocks where institutions frequently trade, and also using Fibonacci entries, apply Fibonacci levels to pinpoint optimal entry points. I do have a Fibonacci video up on YouTube right now. So if you're watching this video, definitely feel free to hop over into the Fibonacci video where I explain key levels. I give you exactly the Fibonacci that I use on my charts. I don't really I do actually go into how I actually use it. I thought I didn't, but I did go into how I necessarily use it on order blocks. So definitely feel free to tap into that video if you guys want more clarity on exactly how to capitalize on trading order blocks. Wait for confirmation before entering. So avoiding first reaction spikes. So wait for price to stabilize to confirm market direction. So waiting for price stabilization is most important. When you see these spikes in the market, they're usually an indication of just either spread or something happening with the news, or institutional money coming in. So make sure that you're paying attention. And excuse me, guys, making sure that you're always staying on top of your trades and not impulse trading when you're seeing those spikes. They're not always a good thing. Sometimes if you execute properly, you can get a wick entry, and that's really good, if it goes in your favor. And, I love it. If you like it, I love it. But make sure that, we're always protecting our capital, and make sure that we're always waiting for price to stabilize before we enter our trades, and make sure it's going in the direction that we're intending to, go in. Thanks for watching, guys. If you made it to the end of this video, you're taking your training journey seriously. Appreciate you guys for watching. Don't forget to like and subscribe if you want more videos like this. Comment below if I missed anything, or if there's something you would like me to add on part 2. And I'm Hublot, and I'm out.